Welcome to this video. Today we're going to talk about the top 3 AI stocks with massive upside potential. And these companies are one of the most overlooked companies. We all know about Nvidia, Microsoft and ASML, but we don't know about these 3 companies. And in this video we're going to do a deep dive analysis in these companies and why they could bring a massive opportunity for the long-term investor. So without further ado, let's dive right in. So the first AI stock with a massive potential on my list is Nebius. And Nebius is a company that operates as an AI infrastructure business. And what they're essentially doing is they're building data center everywhere. And they rent all this power that they're producing out through the cloud to other small companies who want to make money through AI. And they don't want to build their own whole supercomputers and data center because it's expensive. So they're renting out this power to small businesses. And that is their business model, and this company has huge potential. So we're now looking at the charts on TradingView, and we're looking at the charts of Nebius. You can see it's now trading in the pre-market at $88.88. And if we look at the trend, it looks like it's making higher lows and higher highs, and this is a really good technical uptrend. So based on the technicals, I would say the most likelihood is that we will see higher highs again. But is this still also a strong fundamental company? Let's find out. So this company is a little bit of a high risk, high reward company. They're not always profitable, but when we look at the revenue, we can see that in the last few quarters, it grew tremendously, like plus 124%, plus 400%, plus 700%, plus 400%. So in quarter 1, 2024, it was 11 million. And quarter 3, 2025, it's 146 million. That's more than 10 times. And that's insane. And that's why I think this company could have a lot of potential despite the earnings not being optimal at the moment. So revenue is growing rapidly, but the earnings aren't optimal yet. And that's why Alpha Spread says that this company is really overvalued by 92%. So their value is based on a discounted cash flow model and a relative value, and they took the average with an intrinsic value of $7, which is really low. I think they are too pessimistic, and I think it is a little bit overvalued, but I wouldn't say like this overvalued. But that makes this company a little bit more risky. But once they become profitable, once they make a lot of net profits as well, and the margins become better, then the intrinsic value can increase tremendously. But yeah, this makes the company a little bit more risky because it doesn't have strong net income yet. We're now looking at Finviz, and we're going to look at the price to sales ratio to find out whether it's cheap or expensive. And this also confirms that it's quite expensive with a price to sales ratio of 63.42. And the price is basically the market cap divided by its revenue. And 63 is pretty high. Here we can see the price to sales ratio compared to its competitors, and we can see that Nebius Group is around 50 to 66. And CoreWeave is around 6 to 10, and Amazon is around 3.4. So based on the competitors, Nebius is a little bit expensive at the moment. Despite the overvaluation of Nebius, I still believe that this company could have a huge potential in the next 5 to 10 years because it's in the AI infrastructure business. That's a high demand sector, and they are well positioned in the current AI boom. And the technical trend is still up, which is great. The market just opened. It's now trading at $88. And I think that this company still has a lot of upside potential. But I think buying right now, you don't have like the biggest margin of safety because it's relatively expensive. But the next company I'm going to talk about is actually very undervalued. So let's continue. So the second company is SMCI, Super Microcomputer. And this company basically makes servers, and they sell these servers to other companies. And they're also in the AI infrastructure business, but they don't sell out the computer power. They make the supercomputers from like the Nvidia cards and the Intel chips, and they build like this supercomputer that's already optimized, ready to use for companies. So they're selling servers, they're making the hardware, and that's what they're doing. And they're well positioned in the AI boom. And this company has a lot of potential, and it's actually very cheap, which I'll show you later. We're now looking at the charts of Super Microcomputer, and we can see it's now trading at $31.81, and it's close to the 200 simple moving average. And this could, based on technicals, be a good time to buy. And we can see that from all-time highs here in 2024 March, it declined all the way now minus 73%. So they already had a massive run-up during the AI boom that started in 2022. And I believe that this company has a lot of potential and it could make a second wave that can go all the way to all-time highs and beyond. So the technicals look promising right now as a buying opportunity, but is this also a strong fundamental company? And how cheap is it actually? We're now looking on Guru Focus and we can see here a quick financial overview of the company. And this company is much stronger. The financial strength is around 8 out of 10. The profitability rank is out of 8 out of 10. They are actually profitable and they have a positive net income. And the growth rank is a 10 out of 10. And we can see here that the revenue grows exponentially and the cash and debt levels are in healthy conditions, which is great. So what is an economic moat? An economic moat is the competitive advantage belonging to a particular business that protects its profit margins from competitors in a market and other external threats. So if a company has a strong wide economic moat, it is protected against competition, and that is good for long-term survival. And here we can see that the economic moat consists of a network effect, switching cost, economies of scale, and intangible assets. If a company thrives in one of these aspects, it increases the moat strength, which is great for a company. And as an investor, it's really important that a company has a strong moat. In this economic moat analyzer, we can see that Supermicro had a narrow moat and the moat score is a 6 out of 10, which means that it does have a moat, but it's not the strongest yet. So Supermicro has hardware design expertise and growing demand in AI infrastructure, but lacks strong brand power or lock-in effects and faces many competitors in the server and component market. In the future, this can become a wide moat if they become stronger in these 5 categories. So the strength of this company is strong position in the AI server market, agile and quick to market with new technologies, customization capabilities for enterprise clients, risk competitors like Dell, HP, Lenovo, commoditization of server hardware, reliance on component suppliers, and exposure to volatile semiconductor cycles. We're now looking on Alpha Spread again, and Alpha Spread gave an intrinsic value of $76.84, and it says that this company is extremely undervalued, 59%. So that means that it's really cheap, which is great for the long-term investor. And they use a discounted cash flow model plus relative value, and they took like the average. So in the base case scenario, it's undervalued by 59%, and in the worst case scenario, it's still undervalued by 43%, which is great. So for a double check, I calculate the intrinsic value also by myself with this intrinsic value calculator based on Warren Buffett's owner earnings. And these owner earnings are for the stockholders and we discount them to present value. And I'm going to use a earnings growth rate for the next 5 years of 15%, which is very conservative. It's growing much faster. And after that, it will halve. And we're using a discount rate of 8% because it's a tech stock. And I filled in all the numbers and we can now calculate it. And we can see that I also come to the conclusion that it's extremely undervalued by 37% and that the true value per share is $50. And this is like with a very conservative numbers. If I put higher numbers, then it will be even much higher. So according to my valuation and Alpha Spread, buying right now would give investors a margin of safety. The third company on my list, and you've probably heard of this company, is Intel. And Intel makes chips. They make CPUs, processors. And you've probably heard of Intel Core, and they are in a lot of computers, and they've been around for many, many years. But the thing that makes Intel unique is that they're not just designing these chips, they're also making the hardware. And they are not 100% dependent on Taiwan Semiconductor like most other companies. And that's what makes this company very unique. So this company is less dependent on other companies, and that gives them a economic moat, which is great for this company. And I think Intel still has a lot of potential and it is in a turnaround phase. We can see here that Intel is now trading at $37.88. We're looking on weekly candles and we can see that it has gone up a lot since the bottom. So it's up over 100% since the bottom, but the overall trend seems still negative on weekly candles. But if we look here on daily candles, we see that it's a strong technical uptrend, which is great. So can this continue? Well, we need to look at the fundamentals first, whether this company can be good for the long-term investor. So we can here see the net income of all the quarters of Intel, And we can see here, for example, that in the last quarters in 24, quarter 1, 25, they were all negative, but the last quarter in quarter 3, 2025 was positive with 4.06 billion, which is really good for the company. So they're finally getting more profitable again. And that's a great sign. And if we look here at the revenue, it was also increasing in the last quarter. So here we have like a quick overview on Guru Focus, and we can see that the financial strength is a 5 out of 10 and the profitability rank is now a 7 out of 10. So their biggest risk right now is like they do have a lot of debt compared to cash, but it's not really out of hand, and I don't think that this is a problem for the company. So is the company cheap? Well, according to Intel Core, it's a little bit overvalued. According to this graph, we can see that the intrinsic value is catching up with the true value per share of Intel, and it's pretty close at the moment. So I believe that Intel is a company with a lot of potential, but it's a little bit expensive right now. Not too expensive, but it will be better to add more shares when it's around there $30 if it retraces to there. In short, Nebius, SMCI, and Intel are all three companies with huge potential, and they are companies we need to keep an eye on. But I personally believe that SMCI is the best price for money, is the best value at the moment. It's really cheap and it has a narrow moat, but it does have a moat, and it's very well positioned and in the AI boom. So I think that buying SMCI gives a wide margin of safety, and there is a lot of potential upside for this company. And I think this company can go to all-time highs and beyond. Of course, always do your own research. This is for educational purpose only. If you like this kind of content, feel free to like and subscribe, and I'll see you in the next video.